Welcome, welcome, welcome. This is your host, Josh Logan, and you are listening to Confessions of an Insider. This is the place where automotive strategy meets market reality, the ASMR edition. This is our very first episode, and the mission for this show is simple: to connect the dots. The auto industry is a complex machine, and every week we're bombarded with data, headlines, and noise. Our job here is to cut through it, find the signal, and understand the real story that the numbers are trying to tell us. So let's get right into it. The theme this week is pressure, the immense financial pressure on the consumer. And that pressure starts the second that you walk into the showroom.
Okay, so let's dive in. Picture this. You've done the research, you've got your financing sorted, you know the MSRP. You walk into the dealership feeling prepared.
Right, ready to go.
And then you see it, that second sticker, the market adjustment.
Yep. And suddenly those reports you read about average prices dropping, they just don't seem to match what's right in front of you. It's confusing.
Totally confusing because the data, the national data, says the average transaction price, the ATP, is around, what, $49,000?
It's about $49,077. Yeah. And technically that is about $2,000 below the average MSRP, which is closer to $51,100.
So wait, if the average price paid is below sticker, doesn't that mean the problem is kind of solved? Markups are gone.
See, that's the trap. That national average number, well, it hides what's really happening for a lot of buyers.
Think so.
It's heavily skewed, pulled down by vehicles with really high inventory, lots of domestic models maybe that dealers have to discount just to get them off the lot. But if you're looking for one of those popular trucks or a specific SUV or, say, certain import brands, the markup situation is definitely not over.
Got it. So for those cars, this inflation, the extra cost, is still the big hurdle to actually affording the thing.
Exactly. That's the real affordability barrier for many people right now.
So let's break down how they inflate that price. Beyond the official window sticker, the Monroney sticker.
Right. The one's legally required, shows base price, options, destination fees.
Yeah. They seem to have a couple of main tactics.
They do. First, there's the really obvious one, just a line item that says market adjustment, pure dealer profit.
How much are we talking?
It varies wildly. It could be $2,000, could easily be $10,000, or even more on really hot models, just added on.
Wow. Okay, and the second tactic.
That's often the dealer addendum. It's another sticker, usually right next to the official one.
And this lists extras.
Mandatory extras. Often things with very little actual value, purely designed to pad their profit margin.
All right, like the infamous nitrogen in the tires. I've seen that for like $199.
Which is crazy when you remember, first, regular air is already 78% nitrogen.
Yeah, right.
And second, even if you wanted pure nitrogen, a tire shop might charge you, what, maybe $10 a tire? Maybe $30 total if they're feeling generous.
It's indefensible. Or the VIN etching, charging like $299 for that.
Yeah. You can literally buy a kit online for $25 and do it yourself in 10 minutes. It's audacious.
So how do they get away with this? What allows these tactics?
It really boils down to one key market factor. This is critical for you, the buyer, to understand. It's called days supply.
Days supply. Explain that.
It's pretty simple, actually. It's the average number of days a specific model sits on a dealer's lot before it's sold.
Okay.
And this single metric basically splits the car market in two. It dictates who has the negotiating power, you or the dealer.
So low days supply.
Low days supply means you're in a seller's market. The cars are selling fast, inventory is tight. The dealer holds all the cards.
Which brands tend to be in this situation?
Think about the really high demand stuff. Often Toyota, Lexus, Honda. For those vehicles, frankly, just paying MSRP without forced add-ons. That's considered a win these days because markups are almost expected.
Okay, so the flip side must be high days supply.
Exactly. Now you're in a buyer's market. These are vehicles that are sitting on the lot longer. Think maybe some Dodge, Ram, Chrysler models, sometimes Lincoln.
So more inventory means the dealers are more motivated to sell.
Much more motivated. They need to move that metal. Your leverage goes way up. You should absolutely be negotiating below MSRP in those cases.
And we have to connect this back to the actual financial hit, right? That markup isn't just a number on paper.
Absolutely not. Let's take a $5,000 market adjustment. Okay, you're almost certainly financing that car.
Right.
Which means you're paying interest on that $5,000 of, well, pure fluff. It adds nothing to the car's value.
So how much extra does that cost?
On a pretty standard loan, say 72 months at 7% interest, that $5,000 adds almost $1,100 extra just in interest over the life of the loan.
Wow, nearly $1,100 down the drain. And what about the monthly payment?
It bumps it up by about $85 a month.
Mm,
And that $85 is often what forces people into bad decisions.
like scritching the loan term out even longer.
Precisely. Suddenly that 72-month loan becomes an 84-month loan just to try and make that monthly payment look affordable because the principal amount was artificially inflated by that markup or those add-ons. It's a dangerous cycle.
Okay, so the defense strategy, how do you counter this when you're at the dealership?
Your absolute best defense is focusing relentlessly on one number and only one number, the out-the-door price.
The final price, including everything, taxes, fees, add-ons, the works.
Everything. Don't negotiate the trade-in separately. Don't negotiate the monthly payment in isolation. Negotiate that single, final, out-the-door figure.
And be ready to.
Be ready to walk away. Seriously. And you need to be firm about refusing those worthless add-ons on the supplemental sticker. The nitrogen, the vinetching, the fabric protection for $500. Just say no. Politely but firmly.
So the real power comes from knowing the market for the specific car you want.
That's the final thought, really. Your ultimate leverage isn't just knowing about markups, it's knowing the inventory situation for the exact model you're targeting. Use that day's supply data. Find out if the supply and demand economics for that vehicle favor you or the dealer. That knowledge is your best weapon against paying for air.
So let's be clear about what that data means. The market adjustment isn't just a frustration. It's the source code for the entire affordability crisis. Before a single financing number is discussed, before interest rates, before loan terms, the price of the vehicle itself has been artificially inflated by thousands. This isn't just a few bad actors. This became a systemic practice, a way to capitalize on inventory shortages. But now, even as inventory recovers, the habit remains. It creates a fog of war for the buyer. How can you compare deals when the fundamental price of the car is a moving target? You can't. And this initial act of squeezing the consumer has a massive ripple effect. It's what pushes a family that could afford a $35,000 car into a $42,000 hole. It's what makes a reasonable monthly payment impossible without resorting to the dangerous financial products that we'll be exposing in future episodes. This pressure is the root of the problem, and it forces consumers to make different, sometimes drastic choices. We're seeing a massive shift in what people are buying, not just here, but globally. And the latest data out of Europe is a perfect example of this.
Welcome back to the Deep Dive. Today we're really getting into the weeds with the latest European car registration figures. We're looking at August 2025, and the headline figure, it looks pretty calm, doesn't it? Overall market up 5.3%.
Right, sounds steady. Business as usual.
Exactly. Sounds like nothing much is happening. But, okay, let's unpack this. Because if you look just below that surface number, it's a total revolution under the hood.
Yeah, that top line stability is really a smokescreen. The real action, the story, it's all happening in the powertrain split, what people are actually buying.
So what's the mission today, then? What are we trying to figure out?
Well, I think we need to understand why this data seems to scream that, pragmatism is winning out over prophecy right now, and specifically how hybrid electric vehicles, the HEVs, have just, boom, become the undisputed kings.
Okay, the hybrid story, I mean, the growth there is just, it's explosive, isn't it?
It really is.
It feels like we've moved past talking about it as just a strong trend. This looks more like a fundamental realignment of the whole market.
Yeah.
The HEV market share, it jumped from, 29.7% just last August?
A year ago, yeah.
To a massive 34.7% this August. That's more than 1 in 3 new cars sold now being a hybrid.
1 in 3. It's huge.
But hang on, hybrids aren't exactly new tech, are they? They've been around for ages, so why now?
Yeah.
Why this sudden surge in 2025? What's the trigger?
Well, that's the fascinating part, isn't it? It seems the average car buyer has just collectively decided, okay, this makes sense. The hybrid, it offers that perfect sweet spot right now.
The compromise.
Exactly. You get really good efficiency gains, lower emissions, which, let's face it, everyone wants now, but you don't get the big downsides of, say, pure electric.
Like the high initial price.
The high price tag, yeah. Or the range anxiety people still talk about. And critically, you're not dependent on a charging infrastructure that's still, patchy.
Well, uneven, definitely.
So for that mainstream buyer who's maybe watching their budget, maybe unsure about charging near them, the hybrid isn't just a temporary step anymore. It feels like for them, it is the destination right now anyway.
Right. And if hybrids are shooting up like this, that gain has to come from somewhere, right? Someone's losing out.
Oh, absolutely.
When we talk about this violent realignment, we're really seeing the flip side, which is the collapse of the old guard, traditional combustion engines.
Yep. Total collapse is maybe strong, but it's dramatic. Pure petrol and diesel, if you lump them together, they're now a definite minority, just 37.5% combined.
A minority. Wow.
And the decline feels structural, you know? It's not just a blip. Diesel is basically in terminal decline. It's down to single digits now, 9.4% market share.
9.4. Practically a niche.
Almost. But the real shocker, I think, is gasoline. Pure petrol cars. Their share just crumbled. It went from almost 35% down to 28.1%. That's a rapid drop. People are actively walking away from pure internal combustion.
So they're making a conscious choice. It's not just drift.
It looks like it. They see the hybrid, they see the immediate fuel savings, the proven tech, and they're voting with their wallets, choosing that tangible efficiency you get today.
Okay, so that brings us to the battery electric vehicle story. The BEVs. Because this is where the data seems to clash maybe with the narrative we hear all the time.
The inevitable future narrative.
Right. Electrification is coming. It's unstoppable. But then you look at these BEV numbers. Yes, they're up from 12.6% last year to 15.8% now.
Which is growth. You can't deny that.
It's growth, but it feels, I don't know, a bit labored. It's not that exponential curve, that explosion everyone predicted. And here's where it gets really interesting. They seem to be hitting a bit of a wall, struggling to break past this sort of mid-teen market share.
Yeah, it feels like we've hit the point where, reality bites for BEVs in the mass market, that hybrid buyer we talked about, the pragmatist. The BEV hasn't quite won them over yet. And it boils down to those same persistent hurdles we keep hearing about.
Still the same issues.
Pretty much. That purchase price premium is still significant. People are genuinely anxious, it seems, about long-term battery health. What happens after 8 years? What's the resale value going to be?
That's a big one, resale.
Huge. And crucially, that public charging network across the EU, it's just not consistent. It's better in some places, sure, but unreliable or sparse in others. The promise is there. Definitely. But the day-to-day reality still involves too many ifs and buts for a lot of people.
So, putting it all together then, the big takeaway seems pretty clear. The European car market right now is just fundamentally hybridizing, and it's happening fast because buyers are choosing what works now, practicality.
Exactly that. Pragmatism over prophecy, like we said at the start. The data points towards full electrification as the ultimate end goal way down the road. But the actual journey millions of drivers are taking today, it's clearly signposted hybrid.
Proven tech winning out for now.
For now. And look, this raises a really important question, maybe for you listening. Thinking about your own situation. What specific thing needs to change for the promise of the BEV, that electric future, to finally outweigh the sheer, simple, everyday practicality of today's hybrid?
Is it price parity? Rock solid charging everywhere.
Guaranteed battery life.
Exactly. What's your tipping point? Because the answer to that is probably what's going to shape this market for the next few years.
The key word there is pragmatism. The European consumer is voting with their wallet, and they're not voting for the government-mandated ideal. They're voting for what solves their problems today. And the problem is high fuel costs and emission concerns. But the solution for the mainstream buyer is not the pure EV. The solution is the hybrid. It delivers 80% of the benefit with none of the drawbacks. No range anxiety, no dependence on a still developing charging grid, and a much lower entry price. The collapse of pure petrol and diesel is the big story here. It's a structured decline. But the fact that hybrids are capturing almost all of that fleeing market share while battery electric vehicle growth begins to plateau is a massive reality check. We're seeing the same undercurrent here in the United States. The initial EV hype is meeting the friction of everyday life, and brands that invested heavily in hybrids like Toyota are reaping the rewards. This is what happens when strategy meets market reality. But what happens when the market reality is that consumers are simply hitting a financial wall. When the pressure we talked about earlier becomes too much, well, we just saw the first major casualty of that reality, and it's a big one.
Okay, let's dive into the recent CarMax earnings. We're looking right at their Q2 report, which was, well, pretty catastrophic, and that 20% stock drop that followed. We think it's more than just a corporate stumble. It feels like a real signal, maybe the canary in the coal mine for this great squeeze we're seeing in consumer affordability.
It really is. You can't really overstate it. CarMax is the biggest player. They have all the data. So when they fall apart like this...
You mean something bigger?
Exactly. It means the customer base is stretched thin, really thin. You know, these high prices, rising rates, it's cracking the whole used car model.
Right. Let's get into those numbers because the scale of the miss was pretty shocking. Earnings per share, they missed by 37%. They reported $0.64. But everyone was expecting over $1, around $1.03. It's a huge gap in profitability per share.
A huge gap. And then the revenue missed too, nearly $400 million short of what analysts expected. But for me, the number that really screams trouble operationally.
The comp sales.
Yeah, the comparable store sales, down 6.3%. They were actually expected to increase slightly, maybe 1.1%. So that reversal, it's brutal. It tells you the problem isn't inventory or pricing strategy primarily, it's demand. People just aren't walking in the door or, clicking online like they used to.
That really undermines their whole volume-based model.
Completely. Scale doesn't help if the customers aren't there.
Okay, so beyond those headline misses, you pointed out something buried in the financing arm, CarMax Auto Finance, or CAF. Their income dropped 11.2%.
Yes, and this is critical. You have to ask why it dropped. It wasn't lower loan originations primarily. It was driven by a massive 40% increase in the money they set aside for loan losses.
40%, wow.
40%. That's CarMax basically saying, we expect a lot more people who bought cars from us recently, likely at inflated prices, to default on their loans. This is the hard number, the smoking gun showing that consumer credit is under serious strain. People are financially underwater on these vehicles.
Now, the CEO did mention a couple of things, right? Like demand being pulled forward, maybe some impact from vehicle depreciation.
Sure, they mentioned those factors, and depreciation is real. But look, their retail gross profit per unit actually held steady. It was $2,216.
Okay, so if they were still making the same profit on each car sold.
Exactly. It suggests the problem wasn't that their margins got squeezed. The problem was finding people who could actually afford the car and the loan payment at those prices and at current interest rates.
So it points back to the buyer just being tapped out.
Pretty much. You've got higher rates thanks to the Fed, stubbornly high vehicle prices, maybe student loans kicking back in for some. It's just a toxic mix for affordability. The buyers at the margin, they're just priced out.
Right. So pulling this together, what is this CarMax situation signal for you, the listener? It seems like there are two sides to this coin, given CarMax's size and influence. On the one hand, maybe some good news. This kind of demand destruction, it has to lead to lower used car prices eventually, doesn't it?
You'd certainly think so. That's the positive takeaway for patient buyers. If demand craters like this, prices should follow, maybe soften over the medium term. So relief could be coming if you can wait.
But there's a negative side, too.
Oh, definitely. The immediate fallout from that huge jump in expected loan losses, it's predictable. Lenders, not just CarMax, are going to get nervous. They'll tighten up credit standards. So if you need a car soon, and maybe your credit isn't absolutely perfect, getting that auto loan just got tougher.
Yeah.
Probably more expensive too.
So less available credit, potentially.
Right. This CarMax collapse, that 20% stock hit, it feels like a real tipping point. It's where, abstract things like inflation and interest rates suddenly become a very concrete, very painful hit to market value. It's a loud warning siren for the whole auto industry.
A 20% stock drop in a single day? That is a 5-alarm fire. CarMax is the biggest player in the game, and their results show, unequivocally, that the consumer is hitting a wall. The most critical number in their entire report wasn't sales. It was the massive 40% increase in money they had set aside for loan losses. People are struggling to pay. So now we have the full picture. The dealership inflates the price, and the consumer, under immense pressure, stretches to make the purchase. We've seen the consequences of that stretch in the CarMax report. But how do they stretch? They are offered a solution, a way to make the impossible payment seem possible. That solution is a dangerous financial product that has become terrifyingly common, and it is the final piece of the trap.
Okay, picture this. You've done all the hard work, right? Negotiated the price, fought off the extras.
Yeah.
You're basically ready to leave because that monthly payment, it's just, it's too much.
That's the exact moment, isn't it, when you're most vulnerable?
Yeah. And the finance manager leans in real smooth and says, look, what if I could get that payment under $520 a month? Feels like salvation.
It really does. But that feeling, that wave of relief, it could be one of the most expensive feelings you'll ever buy.
Because that's the offer for the 84-month loan?
Exactly. The 7-year sentence of debt. And, our mission today is really to pull back the curtain on this trap. It's not some fringe thing anymore.
No.
No, it's becoming the go-to answer for dealers facing this vehicle affordability crisis we're in.
Okay, let's set the stage then. Just how big is this crisis?
We really need that context. I mean, the numbers are kind of staggering. Total auto loan debt outstanding, $1.66 trillion as of Q2 2025.
Wow, trillion.
Yeah, and what's worrying is the distress signal. The serious delinquency rate that's people 90 days or more late, it's climbing. Close to 3% now.
Okay.
And the average new car loan, already 69 months. So this 84-month thing, it's not an outlier. It's just the next kind of dangerous step. It's feeding this huge pileup of debt.
Right. So that's the big picture. Trillions in debt, people struggling. What are the specific traps, the things you miss when you're just staring at that tempting low monthly payment?
Let's break it down. There are really 3 silent killers with these 7-year loans.
Right. Killer number 1.
Negative equity. It's almost guaranteed. See, new cars lose value fastest right at the start, the second you drive off the lot.
Depreciation, yeah.
Exactly. But with an 84-month loan, your payments are so heavily weighted towards interest up front, almost none of your early money actually chips away at the loan principal.
So you owe more than the car's actually worth. You're underwater.
Immediately. And for a long time. Maybe 4 or 5. I've even seen cases where it's 6 years before you have any real equity.
And the risk there is if the car gets totaled or something.
Oh, yeah. You're writing a big check to the finance company for a car you don't even have anymore. On top of getting a new one, it's brutal.
Okay, that's bad. What's killer number 2?
The interest cost. Pure dollars and cents. You're essentially buying time, lowering the monthly payment.
But it costs you.
It costs you big time. The interest rates on longer terms are often higher, too. We ran the numbers stretching from, say, a 72-month loan to an 84-month one. It might save you maybe $69 a month.
Okay, sounds tempting.
But that convenience costs you an additional $1,408 in pure interest over the loan.
$1,400 extra, just for those last 12 months.
Just for those months. Now let's compare that 84-month loan to, the responsible standard.
Yeah.
A 48-month loan. What's the total interest difference there?
It's huge. The 7-year loan costs you $4,142 more in interest than the 4-year term.
$4,000.
Yeah. It's a massive penalty, all hidden behind that lower monthly figure.
Which leads perfectly into the third killer. This one's kind of insidious. The warranty versus payment race.
What do you mean?
Well, think about it. Your factory bumper-to-bumper warranty, usually gone after 3 years. Powertrain. Maybe 5 years.
Right.
But you're still making payments for year 6, year 7 on an 84-month loan. This guarantees you'll be paying month after month on a car that's aging and needs repairs. Repairs that aren't covered.
So you're stuck with, your $528 car payment and maybe a surprise $2,500 bill for a new transmission or something.
Exactly that scenario. It's a financial double whammy waiting to happen.
Okay, this sounds terrible for the buyer. Why on earth would a dealer push this?
Well, honestly, it solves their immediate problem. It overcomes your payment objection, makes that expensive truck or SUV suddenly seem affordable month to month.
Gets a deal signed.
But it also fuels their real profit center, the F&I office, finance and insurance.
Ah, the add-on.
Yep. That super long-term makes things like GAP insurance, which covers the difference if you're underwater, and total the car seem absolutely essential because, you are underwater for so long, it also justifies extended warranties, other high-margin products.
And this creates a cycle, right?
A vicious one. You trade in that car after 5 years, still owing money on it. That negative equity gets rolled into the next loan. So now you need an even longer term just to keep the payments manageable. You dig the hole deeper.
Okay, okay. Enough doom and gloom. We need an escape plan. How do people avoid this trap? What's the smart way?
There's definitely a smart way. The gold standard we talk about is the 24/10 rule.
24/10. Break it down.
Simple benchmark.
Yeah.
20% down payment minimum. Finance for no more than 4 years, that's 48 months.
Okay.
And crucially, keep your total monthly vehicle costs, that's payment, insurance, and fuel, under 10% of your gross monthly income.
10% total. That really forces you to buy
Oh,
realistically.
it does. It protects you.
And what's the best defense tactic before you even talk numbers with the dealer?
Get pre-approved for financing. Go to your own bank, your credit union, before you set foot in the dealership.
Why is that so important?
Because it shifts the power. You walk in knowing what you qualify for, what rate you can get. You're not relying on their financing games. You're negotiating from strength.
Removes that vulnerability point we talked about at the start.
Completely. The takeaway really is the shortest loan term you can comfortably, genuinely afford is always the best financial move. You have to fight that tunnel vision, looking only at the monthly payment.
Yeah, look at the total cost, the whole picture.
Exactly.
All right, let's leave our listeners with something to think about. Here's a provocative thought. You should probably never be making payments on a car that's outside its original factory warranty.
Ooh, that's a good one. Puts it in perspective.
Right. So, ask yourself,
Mm-hmm.
how much sooner could you pay off your next car and save all that interest if you just bought the vehicle you could truly afford on a 48-month term? That's how you actually win the long game with car buying.
And there it is. That's the anatomy of the bad deal. It starts with an inflated price tag from dealer markups. It leads to a consumer base so financially squeezed that the industry's largest retailer starts to crumble. And it ends with the consumer being offered a 7-year loan as a lifeline that locks them into years of negative equity and high interest payments. From the sticker to the stock market to your own finances, it's all connected. It all comes back to the great squeeze. That's our show for this week. Thank you for tuning in to the premiere of Confessions of an Insider. You can find all the data, charts, and full articles for everything we discussed today on theloganzone.com. Stay sharp, stay informed, and we'll see you next week.